Okay, good, David.
Hi, everyone. I'm Dave Lewis. I'm a lawyer at Goldston Stores, and just want to say welcome. Thanks for joining our first webinar. I'll turn it over to Macy to talk a little bit about HREAO, and then we'll dive into today's presentation.
Welcome, everyone. Thanks for joining us from different parts of the country, different parts of the world. We're very excited because this is our first webinar in our webinar series for HREAO, and we're going to focus on discussing on affordable and multifamily housing, especially within the current landscape in COVID-19 and how we can navigate and what we're observing. HREAO, as most of you guys know, is a real estate SIG, small interest group, related to the Harvard Alumni Association. It's official SIG and only SIG that really specifically focuses on land use, real estate, related professions, so design, development, capital market, policy, etc. Usually our members are in all different sectors and also all different stages of life. There can be students, there can be professional. We started in 2009, and the idea was to bring together in school and after graduation with all the alumni, folks who are interested in discussing land use and real estate, but also folks who are practicing in it, and just anyone who's interested in learning about it. So, feel free to email us. We have our email below, as well as our website. Feel free to join as a member, and look forward to seeing you guys in future events. Just a quick introduction for myself, and then I'll turn it over to Eamon. My name is Macy Leung, and I graduated in 2011 from the GSD in MDes, specifically in real estate. And I've served on the board of HREAO since 2012, I believe, so it's been quite a while. And we put together different events, and I'm based in the West Coast. I'm in the Bay Area. And Eamon and David, they're both leaders in Washington, D.C. on the steering committee. My profession, I'm a developer in affordable housing, specifically in permanent supportive housing and homeless housing with ground-up construction in the West Coast, primarily in the Bay Area. So with that, I'd like to turn that over to Eamon and introduce himself.
Hi, my name is Eamon Lawrence. I'm a 2009 law school grad, commercial real estate transaction lawyer by trade. Started out at a large international law firm, then went to specialize more in affordable multifamily housing, particularly on the development side. I'm now lead transactional counsel for Montgomery County's Housing Opportunities Commission. This is a county of 1 million people located just outside of Washington, D.C. And my agency is the largest landowner in the county, and so we have a number of units and are pretty active with an active bond issuance and also development pipeline program, as well as maintaining and operating an overall portfolio. And also, so I am with a DC branch of HREAO. We've had 2 events previously. One was on affordable housing. We also did something on real estate and technology. We started up a listserv and sent around a survey to gather interest for future types of events. We were going to do a happy hour before the pandemic hit. We still hope to at some point. So if folks are from the DC area and are interested, you can reach out to me directly and I can hook you up on that listserv. So, David?
Thanks, Eamon. So as Eamon mentioned, I'm in the DC area as well, and co-coordinate the DC chapter with Eamon. I'm a 2009 GSD alum, graduating in urban planning. I'm now a lawyer in Washington, DC. About half of my practice is sort of general real estate transactions, kind of a national focus, and then primarily in multifamily housing. And then the other half of my practice is on land use in DC proper. And I get the honor of kind of kicking off today's substantive topics. So as Macy mentioned, we're going to look at trends and disruptions that the 3 of us are seeing right now in the affordable multifamily housing spaces, both in response to the COVID-19 public health issues, as well as the sort of associated economic turbulence that has resulted. So we'll talk about some of the problems that we're confronting. For the three of us, the landscape seems to be shifting daily, sometimes even more rapidly than that. And so we'll speculate a little bit about where we think things are headed. And I just want to caveat that at least as to Eamon and myself, none of this is legal advice. So three topics we want to talk about. We want to talk about development, new construction. That's the first topic. Second topic, capital markets. And the third topic, what sorts of direct impacts we're seeing as a result of public policy initiatives and other direct responses to the pandemic. One kind of format note, this is our first webinar together in this format. So we're going to try to figure out the audience participation piece. A little bit as trial and error as we go. Please bear with us. But feel free to submit questions in the chat box. We'll try to answer them, take them in real time as we can, and others will collect for Q&A at the end, which we'll try to leave 10 minutes or so, 15, 20 minutes or so at the end for Q&A, depending on how involved everyone wants to be. So the first substantive topic is construction and development of new housing, particularly new multifamily and affordable housing. And as I'm sure many or most of you all know, many markets in the US, particularly on the coasts, saw affordable housing as a crisis even before the pandemic. It was a slow but deep crisis. And so this just layers on top of an existing difficult condition, some really unique circumstances. And one thing that I've seen in my practice is a strong push to keep multifamily and affordable housing construction ongoing. It's not entirely clear how that's going to play out. This is kind of an international issue, a common enemy, if you will, but there's been wide variation from one market to another, which kind of magnifies the existing variation from one sub-market or construction market to another that existed before the pandemic. So just a couple things that I'm seeing in my practice. In DC, for instance, construction, particularly housing construction, is an essential activity. So construction activities have been ongoing in DC proper. That has not been the case, for instance, in Boston. Boston construction had fairly substantial shutdown for an extended period of time, which is just now, between yesterday and today, lifting. New York also saw cessation of construction activities, except residential housing was an exemption from that shutdown, as long as it had something on the order, I think it was like 20% affordable housing component. So, these policy responses to the pandemic have been targeted, but varying widely from jurisdiction to jurisdiction. And I just want to mention kind of one other thing on the construction and development front that could be problematic or thorny down the road. And one thing that I've been paying attention to in California is the tolling of challenges under CEQA, and to a period of 90 days after the public health crisis ends. That could really continue to exacerbate the existing challenges of getting multifamily and affordable housing titled on the West Coast. So those are just a couple of snippets that I'm seeing. I'll turn it over to Macy to talk about what she's experiencing in her practice.
Yeah, thanks, David. Happy to. That's a great summary of what's happening, at least in certain coasts, specifically in California. And what I do, because I build affordable housing, specifically permanent supportive housing. Before COVID-19, there were already challenges in terms of funding sources, putting together capital stacks, working through with local and statewide jurisdictions to make sure our production continues to meet the demand of the state and also locally. So we have each jurisdictions in California and the state have specific numbers of affordable housing that the city has to target to produce by a certain time frame. And as developers, and also sitting on the city side, I'm on the design review board, my second term. We always try to put together the capital sources, making sure we're in compliance with the regulatory guidelines to move forward with construction, design construction, and ultimately production of affordable housing. So specifically, I'm working on 4 projects, and one I can echo what David was saying, that we had, it's 125 units, ground up new construction, and it's half of it is homeless housing. It's in the Bay Area, and it's going to be a first all electric building, all modular construction building. But after we got the entitlement via 2 state legislations, COVID happened, so we had to figure out, will the cities continue to keep working with us? What is the regulatory updates, and how are we going to move forward? Fortunately, the state had stepped in and declared affordable housing essential services. So on my end, we continue to move forward with production and design development production. Cities are working from home. But when I got the entitlement approved, I filed for notice of exemption with the state and also with the city and the county. And then the 90-day extension happened that is going to be after the pandemic is over. So I'm hoping that between the pandemic is over and the 90 days that's up, there won't be any challenge on the CEQA side on one of the projects. Same for the other project that I have in North Bay, in the Bay Area. In terms of how it affects design, construction, and production and financing, I can talk a little bit first about production in the context of design development. So our design continues because a lot of the architects are working from home, so they're able to communicate like normal. And we're also working closely with the cities and counties in this case to continue, moving forward with design development and construction document sets. The thing that does affect us slightly is the construction side, because one of my projects is a modular project. The factory capacity is down 50%, and also GCs have a mandate for social distancing on site, and for any of the inspectors from the cities, they have to do social distancing inspection or FaceTime inspections, or clear the entire construction site before they're actually coming onto the job site to inspect anything. So the challenge had been coordination logistically and how that would work, and also how production of the modules on one sense and stick built on the other sense will affect pricing and affect availability of the construction materials. And then, of course, the financing, we can talk about that in the next topic.
Sure. So I would say the big picture from where we are is that things are still moving and moving along in all phases. There's additional hurdles, and so that takes more time to jump through it. But we've got some buildings that are in lease up all the way to things that are in land assembly phase. So lease up are actually still ongoing through virtual lease signups. I think it's been a little slower, but it's going on. The largest impact that I've seen is we have a senior property, and we're trying to do a rehabilitation transaction. And the original plan was to do the rehabilitation floor by floor. And since the pandemic has come, we're thinking that through again. There's 3 buildings in this property, and so there's a internal discussion now about doing a floor by floor rehab versus a building by building rehab. For a building by building rehab, you have to have higher vacancies, so you get less rent during the rehab period. The construction can happen quicker, and most importantly now is there would be less risk of interaction between residents, who are senior residents in this case, and construction workers. So that might be a safer way to go. And actually the rehab would happen a little quicker. So you may have construction costs decline even as rent also decline. the big risk of that approach is, you know, this is an occupied property already, and then so you may have to relocate some residents. And the original plan is that residents would be relocated in the property, and now that wouldn't be possible, so they'd have to be relocated to one of our other properties. And we have them, but you know, that is a burden for a senior, you know, in the middle of the pandemic to relocate to a different property. And so to a certain extent, there's a balancing of the risks for what's best for the residents. And then you have the larger issue of, okay, this is a pandemic, so you know, we have to be cautious. On the other hand, this is an outmoded building, you know, and building will continue to deteriorate if it isn't fixed. And so we do have to, you know, more measured, continue to proceed, but just to do it in a way that's more precise. So what we've seen, for example, is, you know, in most deals, at least from my perspective, the relocation plan is something somebody asks for, and then, you know, you email them the relocation plan, somebody sends you, and then that's it. And we're getting a lot of questions from, you know, our investor about the relocation plan, and from internally about the relocation plan. So that's been a big one. Macy and I remember we're having a little debate about how this long-term is going to impact construction pricing. And I know Macy was saying that she had seen some declines in pricing due to, you know, people looking for work, or a little less optimistic here. And I think it is, you know, maybe more of the buildings, it's a little different than the modular, like larger buildings. And for these, I'm thinking particularly of like large new construction. It hasn't really happened yet, but there's been concerns about whether there would be shortages in material. Shortages in labor have been a little tricky where, okay, it's a recession, so you think a lot of people are looking for work, but in the United States, we offered very generous unemployment compensation if someone was furloughed, like way above, you know, normally it's not generous at all. And then now the rates were very high. And there also were construction workers who were worried about their health and who you know, maybe didn't want to work or felt that they couldn't because they wanted to protect their families. And so even though it's a recession, there's been a little bit of a feeling that labor is, you know, still tight, which it was to begin with. For the other thing that happened is the insurance world is in a total upheaval. That is mostly related to things like business interruption insurance, and there's open questions of whether property insurance is going to cover business interruption. This is less of an issue for, you know, multifamily housing. Obviously, for things like office and retail, it's cataclysmic. I think our portion of the industry is actually more stable. We're seeing that quotes for pricing are going up. We're also getting advice from our insurance agents to be, you know, more careful generally, but particularly they've said, you know, look at subcontractors, subcontractor financials, you know, consider subguard bonding, because, you know, you don't want to start a project and then all of a sudden your, you know, electrical company goes under and the other ones are all booked up. And so we've been adapting. That raises a little bit of a cost. And then also with our contractors on deals that are starting, talking about scheduling and timing, and also including in the construction contract, and this is where I came in, a clause that says this construction contract already builds in, you know, 60 days due to the pandemic. So, you know, basically, if you're required to stop work for 60 days, don't get us a change order. Beyond that, we understand you might need to. But that's the point of, hopefully you plan these things in advance, and then there's fewer surprises. That's different for deals that are ongoing, although in my state as well, construction is an essential business. The work for most of the active deals we're working on is outside right now, and so that really hasn't been as affected. It's more of a problem if you are at the finishing stages of a development, and so you're now inside, and then the social distancing rules come into effect, and that can limit the number of workers that you can have on the site, which is going to slow down the work. And then last point I wanted to hit on is this is an issue that people are talking about in the industry, which is, you know, to what extent is this pandemic considered force majeure? It hasn't, thankfully, impacted any of the projects that I've been dealing with in any material way. You know, some folks have sent prophylactic notices saying, hey, everybody, this is a big deal, and you know, we're evaluating the situation, and there's a clause in our contract about force majeure, and we're sending you this note. You know, some of these contracts are going to have a provision that says you got to let us know in 30 days if there's an issue that you think could impact performance. So if you're in that situation where you're having ongoing construction or ongoing architectural work or something like that, particularly that's physical, you may want to think about sending that notice just as a prophylactic measure, even if things are continuing apace. The consensus, I think, that I've heard from, you know, litigators in the industry is that force majeure may allow excuses in performance or delays. It's not going to stop payments, so you're still going to have to pay your construction lender. You just may get a little more time to hit substantial completion or something. So I could go on and talk about some of the broader issues in the insurance industry, but I don't know, David, if we want to continue through the order, and then, you know, if there's extra time and interest, we can go dig into that topic in more detail.
Yeah, I think that's a good idea. And why don't you move on to what you're seeing kind of on a capital market side, and if folks, you know, please feel free to use the chat box. I hope it's open to everyone who wants to ask questions.
Yeah, I think our Q&A was like mostly at the end, but I think if folks have a question on a particular thing we're talking about, so like force majeure or something, you can put it in the chat box, and then, you know, David can call it out, and so we can hit it on the fly. And then if you prefer, we can wait and address in the Q&A session.
Yeah. I think waiting till the end, then we can address all the questions. But yes.
Okay. Yeah. Macy, do you want to start on capital markets?
Sure, happy to. So from what I have seen and what I'm seeing on the development front, and also speaking with lenders, CDFI, tax credit investors, there's definitely a tightening of underwriting guideline and requirements right now, both on the pre-def construction lending and tax credit. There is a speculation at this point of how much tax credit each state is allowed to have or will have, and also if the bond cap for each state, in California specifically, in each region will be at the cap that was there before, or it's going to be lowered. Already affordable housing, because each of the project that I normally do, we have up to sometimes 9 to 14 different financing sources. So we have public funding, state, you know, county, city funding, private equity, and also a bunch of different state funding, like HCD has multiple different housing programs that we always apply for as part of the capital stacks. And then with COVID-19, there's a lot of speculation right now whether the state will continue to have all of the funding that they had allocated at the beginning in their state budget. If that's going to be revised in May, there's a May revised budget in California, as well as in August will be kind of like a final budget with all the legislation that passes in the House and Senate from May until August this year. So with the state revised budget, I think in August, we can see where we are in terms of budget-wise that's allocated specifically to housing development, housing financing, and social services in affordable housing. And then because of the COVID-19, what I'm also seeing and hearing is the tax credit pricing will be more expensive for investor. And also we're wondering if the government sector will step in, because in 2009, they had stepped in at that time to purchase it, rate pricing and level the pricing out. So we're kind of speculating to see, okay, how much more variance do we have to pay with the increase in tax credit pricing? Hopefully that's offset by a decrease in construction cost, and also whether construction lending will increase in terms of interest rate and more rigorous terms. I'm also seeing on my projects, pre-dev lending for sure, the underwriting guideline is a lot more stringent now because the risk tolerance is a lot lower because of COVID. Folks lenders want to make sure that the projects is able to be executed and carried through within the time frame pre-COVID and then post-COVID-19. So in my discussion, sometimes there had been a lot of back and forth with very specific payment structure that we have to come up with by month to make sure that we can show lenders we can execute in the time frame that we had set in the project. The good thing about California is, especially in the Bay Area, is we have a great incentive on the public sector to help affordable housing on the financing and production side. So there are a lot of funding and legislations and bond that's going to be potential in November ballot that will be helping the production and financing. We also have a lot of tech firms and different large corporate firms, especially in the tech industry now, that is actively putting money in investing in affordable housing production and financing and lending. So Apple put in money, Google's putting in money, Facebook's putting in money. So we actually, some of my projects are financed with Facebook, CZI, and we're talking to Google on some of the money that they will put into the projects. So these will help offset some of the costs on the capital stack that we're trying to structure, that with the absence of these corporate resources may be more challenging to find the money to put together on the private and public sector. So everyone's trying to come in and help, and hopefully that the tax credit allocation and the regulation can also help support continuous production of the much needed affordable housing financing and production in general.
Yeah, I think it's interesting here in the DC area. I know we got a big win with the Amazon relocation, but I don't think that the affordable housing package as part of that was quite as generous as some of the West Coast tech companies are offering, and so that's interesting. I think our sources are usually still the typical sources. I mean, it could be banks, tax credit investors, joint ventures with private developers. We haven't yet, gotten a big tech company to come in and say we want to subsidize housing. Although, if anyone's listening that works there, maybe they might want to think about it. Let's step back. So some of our registrants are overseas, so I want to provide an overall explanation. In the U.S., subsidized housing is increasingly switched to a public-private partnership model. So, for example, I'm at basically a housing authority agency, and we used to have almost entirely public housing working directly with HUD. Over the time we did what's called a rental assistance demonstration, RAD conversion of our whole portfolio that moved it to still HUD subsidies, but more of the same subsidies that a private for-profit or nonprofit would get, like a Section 8 type. We also in the U.S. have tax credit investors will come in and they'll provide capital in return for tax credits, and also the deals are supported with the issuance of tax-exempt bonds for many, but not all of those tax credit deals. It depends on the type. The biggest impact that we have seen personally has been in the municipal bond market, and I would be curious to see if folks, internationally saw this sort of dynamic. What happened was, there was a big crisis in March, and it was not just a COVID crisis, it was a financial crisis. And there was a huge flight to safety. So 10-year treasuries went through the floor, right? Typically, there's a spread between municipal bond pricing and treasury pricing because municipal bonds, even if they're AAA, which is the highest rating, are deemed riskier. That spread grew, and it grew pretty rapidly for a small period of the crisis. So see, I have some notes here, but I'll just, yeah. So, for example, there was one point there, something that's called a variable rate demand obligation. I was talking to our bond folks before this call, and this is where, you know, if you purchased a bond and you wanted to sell it on the secondary market, like a short-term housing bond, the rate for one particular week went from 1.35 to 7 for that particular week. There were no buyers during the height of the crisis for municipal bonds. I think basically everybody either said, we need to cut risk, and they moved into treasuries, or maybe they were opportunistic and they said, stock market is 33% off its peak. And so that's where all the money was being allocated. There was a period of time, about a month, where there was no housing bonds issued in the US because housing bond issuers saw this pricing and they said, I'm not going to issue municipal bonds at this price. Things have since settled down, but that spread is still true. So for example, you know, it's common in the industry to use sort of like a 0.5% cushion in your underwriting to say, you know, we're going to assume that the deal still pencils out even if bond rates, municipal bond rates rise by 0.5, and they've risen more by 0.75. So if you're working on an active deal, you're seeing those bond rates go through the cushion that you underwrote. I think everybody expects that things are going to settle down. The Fed has stated that they're going to support, in particular, the municipal bond market, including through direct purchases of municipal bonds. So as time goes on, that spread will probably decrease, but will it go back to normal? It might be a while, or honestly, there could be issues with budgets in certain places, so it may depend on the particular jurisdiction. I think people might look a little more closely at which jurisdiction is issuing which debt. On the tax credit side, we haven't seen a big change. I think we've seen increased questions about underwriting or, you know, tougher negotiation regarding certain things. So like language in a guarantee or length of an operating deficit period. Other things are business as usual. And, you know, for now, everybody is still willing to close on the tax credit side. I think those are, you know, those are kind of a fixed return, so it hasn't been as impacted as bonds. And then there has been some relief, but a little bit. So the IRS issued a notice that said basically like, you got a little more time if you were in the midst of construction to hit substantial completion. And then also we had a big bill, the CARES Act, that impacted, you know, a whole bunch of, there was a whole bunch of changes to the tax system, but it include removing some of the caps on interest deductions and things like that. So the IRS confirmed, and this isn't an affordable housing thing, this is just a general partnership tax credit thing, or partnership tax thing, not even tax credit. But folks could amend their returns to make elections that were previously irrevocable. So I think the people who that applies to probably know that applies to them, or are working with specialists to understand whether it applies to them. So I'm not going to go into detail about what those particular elections are, other than the fact that you could go back and look at, you know, your tax returns and talk to your accountants and legal professionals. So.
Before we move on from, you know, from capital market stuff, we did get one question about tax credit pricing, and Matt tells us that he's hearing that prices might be decreasing. Macy, it sounds like you think, or you're hearing they might be increasing. Wonder if you could talk about kind of some of the dynamics behind the marketplace as you're seeing it.
Yeah, when I say increasing, it means the project capital is more expensive. But yes, it's actually, it used to be 1.1. I think it was a year ago, around 1.1, but now it might be around 0.9. So definitely, it's in terms of the actual pricing itself, it's definitely decreasing. But in my discussion with investors, it might be more expensive for them to invest, or it might be more stringent to to underwrite the deal. So yes, in terms of pricing, I do agree, and I have seen that. We're expecting that when we do our revised underwriting, that it's going to be maybe 0.9, 0.95, or somewhere around there, rather than like 1.1, 1.2. So.
And I mean, do you think that trend is kind of steady, or do you think it's going to continue to go down?
I mean, I can't speculate, but 0.9, it's the average that I'm gonna think would be trending in the next year, but I don't know. I mean, I don't think it's gonna continue to go down significantly. Usually it hovers between a certain range. But yeah, hopefully not, so.
We got one comment from Andre and about a project in Walnut Creek, California, just closed at 0.975. So
Yeah.
That's consistent, I guess, with what both of you were saying.
Yeah, that's good to know. Thank you. I will put that in my underwriting, 0.97 for now.
So we want to move on to our third topic, which is on some of the direct public policy initiatives and other sort of private initiatives that we've seen in response to COVID-19. Macy, I think maybe we'll have you kick it off again and talk about some of the programs you're seeing in place in California, which are pretty innovative from across the, from our East Coast perspective.
Sure, happy to. So I lead the housing policy group in my company, and I've done that before as well in another company. And so I think right now, so before COVID-19, there had been a lot of initiative on a state level to streamline affordable housing production, increase financing. There were talks about $500 million specifically for increase in funding for affordable housing construction, as well as a percentage of funding within the state budget that's dedicated to financing homeless related production or services as a fixed percentage. Because California, although they have said it's such a priority many times, it wasn't until recent years that housing and affordable housing, especially homeless housing, becomes a top priority. So we've always said there's a housing crisis. Now there's an exponential intensified housing crisis because of COVID-19, specifically to the lowest income tranche, and also folks that have the highest cost burden, both for rental and mortgage. But in this case, because it's affordable housing, it's rental. And so with that, and with COVID-19, the policy in the past shifted from, well, certain things continue to maintain and will continue to be a priority, such as streamlining affordable housing, whether that takes the form of by right production legislation. So there are several bills like an increase in density. So there's like, SB 35, AB 7063, AB 2162. I mean, these are the bills that basically streamlines production of affordable housing, that you can put housing in different location on the general plans. So if it's zoned as industrial, you can use a combination of SB 35 and AB 1763 to increase density. If it's zoned as residential, you can use combination of SB 35 and AB 2162, etc. So there are different ways that the state is incentivizing development via that. And then there are also legislation that are encouraging cities and counties to work together to make sure that the RHNA, meaning the regional housing need assessment need, goals are met. So if there's a certain number of units that each county or city has to meet by 2025, this will help facilitate a partnership between counties and cities. So then they're not, saying it's each other's responsibility to work together to produce this housing production. On the funding side, the state had been putting a lot of money before and had continued to do so back in January in terms of allocating funding for state credit and state funding to finance housing production, multifamily affordable housing production. That budget may or may not be as robust. You know, I don't know, I can't speculate, but there had been talks from assemblymen and senators at the House level and Senate level that, you know, it may or may not be there, but they're thinking of ways to also offset that bucket of money in case it's not all there. So one of them would be raising bonds, infrastructure bond, housing bonds, and put that on a ballot in November. The other is taxing, you know, vacation homes and put that into affordable housing. The others is, you know, continuing different types of housing production incentive like ADUs, granny units, putting it in single family home backyards, you know, so that can be another affordable housing production. And then also just overall increasing units density, doing it by right with secret exemption in some cases, and then also upzoning land. So parcels that are like 4 units can be upzoned to like 10 units in certain areas. And then also state funding wise, the ones that have already been in existence in terms of programs had been funding, you know, near transit, so encourage like TOD development with affordable housing component. So like VTA in the South Bay, you know, BART has always encouraged affordable housing development. So partnering with public agencies on the transit side to ensure that some of the housings are built on the legislation level. So I would say there had been a lot of support from the state and local jurisdictions, but with the COVID-19, with the shifting in resources toward either the health industry or unemployment or something, the resource toward affordable housing may lessen and will be impacted as a result of COVID. But the legislation that helps push forward housing protection and financing may be a little bit more creative in terms of strategies and not just financing itself. It may take different forms of policy initiative from what I've seen so far.
Thanks, Macy. And what are you seeing on the East Coast, particularly in the DC, Maryland area?
Yeah, I think
in terms of direct responses.
For now, I've been focusing a little more on federal guidance and then also notices of federal relief. I'm sure the state of Maryland has initiatives, but I haven't yet seen them in sort of grappling with the day-to-day crisis of, okay, these deals are a lot more complicated and how do you get them closed? So someone raised the question about an eviction moratorium. I did want to hit on that. So that there's various eviction moratoriums. So HUD stated that there's a moratorium for 120 days in evictions and then foreclosures for 90 days on properties that have FHA insured mortgages, and those could be affordable or those could be regular multifamily, or HUD multifamily assistance, which they basically mean Section 8, although there could be other forms of assistance. Maryland has similar rules that aren't related to affordability. I think from our standpoint as a public agency, our commission is in alignment with that. You know, I don't think that that's something that we would be doing in the midst of a pandemic anyway, whether or not it was required. There is an issue that advocates in the industry have raised where you could be put in a situation if this crisis goes on a long time, and it looks like what may happen is this goes on a long time in not as acute way as it is now, where there's a moratorium on eviction, but you still have to pay your lender. If it's not a HUD insured mortgage, the lender could still foreclose. Or you are have a HUD insured mortgage and you can't foreclose, you got to make bond payments. And so when folks in the industry saying, well, look, this is a trickle down effect where if rent stops and eviction stops and foreclosure stops, you know, eventually there's going to be disruption in, you know, commercial mortgage-backed securities markets, which could have a broader impact. So the push is that additional federal assistance should, you know, consider the framework of the whole economy and make sure that things are aligned across the board. That it is more of like medium-term issue, I think, not a like, May 5th issue. What we've also been dealing with is issues that for us relate to existing tenants. So for example, we were closing, it's called a RAD conversion, which is sort of a specific affordable housing type transaction. And we weren't sure whether or not they're going to be required HUD inspections, and those were waived, which was great. And so those inspections are going to happen later. And so that's just an example of ways in which I think that the federal government is being flexible. We have questions we're working through related to how and when to notify tenants if another tenant has a confirmed case of COVID in the building. And on, one hand, there is arguably a duty of care to tenants that is, different people think differently about that, and it depends differently on your jurisdiction. On the other hand, there are patient privacy rights, so you have to be very circumspect about what you say. HUD's guidance recommended that you send notice. We received other guidance from our state and local officials that didn't recommend notice. And so you have to think through, are you going to send out a notice every time, or is it going to be for the first resident? And if it's the first, are you going to say that you're not sending it in the future? And then also you want to make sure you're not like giving any medical advice in the notice, or making sure that there's no information that could lead people to find out the identity of the particular tenant, or at least find out the identity through that notice, which could be, we usually do in large buildings, so that's not a big of an issue. Something to think about if you have a small building, say you're an individual investor and you have a four units, right? And one person gets COVID, do you send a notice to the other residents? Maybe you want to be pretty careful about how you say that. You might want to say it after thinking about it and talking to your own counsel. So Dave, I know you were going to talk a little about the Paycheck Protection Program and some other forms of relief that you've been working with your clients on.
I want to add three things, Eamon and David, as we're talking, that I want to also mention before we get into that, is in California, we also, as part of an incentive, they're also looking at church lands as way of building housing as by right. And the other thing is, because of the wildfire that had happened last year, and so many wildfire in Southern and Northern California, part of the tax credit funding is also allocated toward disaster. So instead of just normal affordable 4%, 9%, we also now have a 9% disaster tax credit for regions that are heavily affected by wildfire, and to build affordable housing needs that tax credit to rebuild the region. So those two have been good things. And then the last thing I want to mention is that because of COVID-19, and I forgot to mention this earlier, the state had actually stepped in about a month ago, reached out to our company, for instance, and took over, was interested in taking over hotels and motels in California. So the state had identified 900 different hotels and motels throughout the state. So they came to us and stepped in and said, we want to work with you guys and the county to lease out some of the motels and put homeless people in there as a temporary shelter, but becomes permanent eventually. And that had been incentivized by the state, where they pay the lease to the hotels directly because they're all shut down, and putting to folks from the streets. And actually a lot of them are COVID-19 positive. So we took over two motel in the Bay Area. There are about 350 beds, rooms, and putting all homeless people there. And that happened like between Thursday to Tuesday. We got under contract over the weekend, and we hired 70 people, and then start operating on Tuesday. And then so now we're looking to buy sites, motels and hotel sites in the Bay Area in partnership with the state and local cities, some cities, to put homeless people there. So that is a creative initiative and policy that has never been done before. but we just saw that as the response to COVID-19. So I want to add that because it's unusual. So.
Oh yeah, I didn't hit on that because that was not my specific job function within the agency, but I know that there are folks within my agency that are working with county officials and have identified certain sites. You know, some of them are ours, or some of them are you know, things like a hotel operator, and everybody's working together. That, you know, private operator and folks at our agency and folks at the other divisions of the county to do similar things. I was listening to a different webinar where the panelists were talking about a situation in Las Vegas where there was workers at a homeless shelter were found to be positive for COVID. So what they did is they cleared out the homeless shelter, and folks were basically sleeping, even like without tents, in a parking lot. And there was this photo of folks sleeping in tents in a parking lot below all of these empty hotels, right? And it's an example of what you don't want to have happen in your city, to have just wasted resources while people are suffering.
It exacerbates the problem. So.
Yeah.
Okay.
That is one of the probably the trickiest problem to solve, both in the short term and really even over the coming months and years. I can imagine the problem is only going to increase in magnitude, unfortunately. But it's good to see that there are creative ideas being implemented. I think that's a pretty heartening thing that has come out of this. Hope there's some sustainability to it. I just wanted to mention briefly, and I saw a question about, I think was alluding to the Paycheck Protection Program and maybe even the CARES Act more broadly. I've spent quite a bit of time, looking at that for clients. It's an evolving field for sure. The Small Business Administration is putting out guidance and answering questions seemingly on a daily basis, sometimes even more often than that. And it's tough to keep up with and make provide good guidance on. I would say the sort of the general rule of what we're telling folks for Paycheck Protection Program loan requests is that it's going to be very fact specific to every applicant. There is an existing set of eligibility criteria that apply to applicants that in general are pretty hostile to real estate interests. So that might be why the one commenter mentioned that it seems like a very low percentage of these loans are going to real estate interests, particularly multifamily interests. That does seem by design under the Small Business Administration existing rules, and it doesn't seem like those rules have been changed in response to COVID. So folks who own or have passive interests in real estate are probably going to be on the outside of the PPP loan program. There may be opportunities for companies that are purely in the management on the management side, but even there, we're seeing some challenges. And again, it's a thorny world that is evolving every day. I've gotten 2 or 3 emails while we're sitting here with new interpretations and new analysis of the PPP. So it's going to take a deep dive for everybody. Another kind of direct response that has come up, and again, it's very jurisdiction specific, but in DC, for instance, we've seen, along the lines of providing relief to people on even on a small basis. The district council, DC Council, which is the legislative body, took action yesterday to impose essentially a freeze on building amenity fees. So if residents are paying fees for access to a gym or something like that, and that's been shut down, the landlord can no longer collect those fees. So kind of to Eamon's point, at some point, that's going to ripple all the way through, and somebody's going to be left shortchanged a little bit. It's unclear really at this point who that's going to be, and I think I think that's part of the answer to the eviction moratorium too, is a lot of these, these legislative or executive actions have been taken, truly in response to the immediate short-term crisis, but without considering what the downstream effects are going to be 4, 6, 8, 18 months from now. Along those lines, we're seeing, I saw for the first time yesterday, news come out that a court in New York State has actually acted on the foreclosure injunction that exists in New York, and upheld the injunction, so at least in the near term. Or the court issued an injunction staying a foreclosure attempt. So I think from my perspective, there's going to be a lot of uncertainty for a while for a lot of these initiatives. I think that's kind of the takeaway. And a lot of it is going to be, sorted out in courtrooms or in mediated settings. That's just kind of my particular bias at the moment. Oh, go ahead.
Yeah, I probably will start to go into Q&A after this, but just one last thing before we did is I didn't know, David, I know you and I were talking about some of the insurance issues related to business interruption insurance and the battles between legislators and the insurance industry. I thought maybe you could mention that DC bill you were talking to me about.
Yeah. So DC tried to legislate a pandemic as being covered by business interruption insurance. It was a very contested issue yesterday, and it got tabled for now. But I think it's kind of emblematic of folks in the public sector rushing to try to provide support for certain industries, but that support is going to come at the cost of someone, and whether it's the landlord or the bondholder or the lender, that really hasn't been worked out yet. And it's tough to make those decisions on a very fast basis, but some of these decisions have to move quickly.
Right. I think that what we're dealing with now is it's clear that there's going to be losses, right? And so it's not clear who's going to bear those losses. Right. And so, the particular business interruption policies are typically tied to property insurance. So the interpretation of the insurance company's counsel is, look, if it was a claim that you would be covered under your property policy, for example, your building burns down, then we got to kick in and pay you business interruption payments during the restoration period. But the business interruption insurance isn't meant to cover a pandemic. There are other people that say that, look, your policies cover mold, your policies cover asbestos. This is something that could be circulating within your building. There was also, in addition to DC, there was a House of Representatives group sent a letter to the insurance company saying that you guys should cover this, and their response, and ladies, and their response was, we're looking at other efforts to provide relief, such as we've been active in charitable efforts, and we've been working with customers to offer flexibility on premium payments, which is basically a response to the insurance industry that they're gonna fight this. And so there's going to be some big court cases about, I think, business interruption in particular, but other parts of our industry.
There's a lot. There's a lot to solve. This is very much the tip of the iceberg. We have a great set of questions to spend another 10 or 15 minutes on. Feel free to continue to submit them. I just want to put a plug in for HREAO as an organization. This is really what we've always intended this organization to be. Those of you who are involved know this. It's really to be a forum for idea shopping, or idea sharing rather, and among your fellow alumni who are in the real estate and related industries. So this doesn't have to be a one-time thing. We hope it's not a one-time thing. There's another webinar on capital markets planned for later this month, so please watch your email for that. And I guess from Eamon and I's perspective, in setting up a chapter in DC, we've always been looking for folks who are interested in and hosting events or planning events or participating in events. Our last event in the fall was, kind of came about as a result of an alumni saying, I have this idea about prop tech. I want to do a panel on it. And we provided the platform, but put it together. So I guess I'd like to just kind of close this out with an invitation that we should all continue this conversation, and on whatever forum or whatever electronic medium we can use these days, and hope you all stay in touch with us and spread the word to your fellow alums.
Yes, and if there's any webinars, ideas, and this goes to the whole country and the world, really, because we have folks calling in from different parts of the country. We'll love to have these webinar series focusing on DC, New York, any parts of the world or topics you guys want to discuss. If you guys want to be part of it, you guys want to host it, we can continue to have these series. I hope it's beneficial. So please provide some feedback as well.
Okay, so I can spend a couple minutes just looking through the questions that we had. We talked about tax credit pricing. We talked a little bit about the bailouts, which I think is about PPP loans. Eviction moratorium. We talked about, one question came up about whether multifamily is going to be more attractive as an asset class relative to other real estate asset classes. I think the short-term answer is it's going to be tough for just about everybody, including multifamily. And I think there might be opportunities of varying levels within the multifamily sector. For instance, student housing or senior housing, at least as a for-profit, senior housing, might have a tougher time. But I think relative to hospitality and retail, possibly even office, multifamily is going to probably be a brighter point in the real estate, real estate asset classes in the capital markets. That's kind of my bias. But I think what I'm hearing right now from clients and folks I work with is it's going to be tough for everybody, at least in the near term. I don't know if Eamon and Macy, you all have any thoughts on that?
Yeah, some of the research we were talking about before we started this panel is we pulled up some data and saw that Macy found that multifamily prices were going down, which is what we expected, but in a lot of markets, single family home prices are actually going up. And some of this is just much less supply. People are saying, I don't want to list my house right now. And I think some of it is folks saying, I was planning to buy anyway, get me out of this apartment. To what extent that trend will continue, where single family becomes more popular, and what some of the knock-on effects, like climate change and planning. Is there a way we can plan single family more smartly than has been done in the past? Are going to be things that our industry is going to have to work through for a while.
Yeah, I think I was looking at the market assessment. I think there's, in terms of the region in the West Coast, multifamily housing start is slower, and absorption is higher in some region and lower in some other, but they're gonna both trending down. With single family, I think, if it's market rate single family, there might be some challenges right now with sales or construction post-COVID. But if it's, I don't know, like medium income, single family, that I'm not as familiar, but there's definitely some shifting in movements in terms of the market.
Yeah, I guess I would just throw it out there that one asset class that may sneakily come out ahead is rental single family. As people, it's assuming kind of as a baseline that people will look to de-densify somewhat as a broader trend. I could imagine that being a product type that gains a bit of it already has a bit of a head of steam, and I think you can build on that. Eamon, there was a question about impact on the RAD programs. I wonder if that's something that you could spend a minute or two talking about.
I want to add, David, about the
Sure.
co-living multifamily. I think we were talking about this beforehand. Before COVID-19, in multifamily, there's the new category of co-living, and that was very popular. It was a very hot category in the past few years, most recently the past 2 years. But it has actually had been affected by COVID-19 because the whole premise of that was based on like community sharing, everything is being shared. So this is pure speculation because there are a lot of layoff in these sectors. In the West Coast, that might be not as popular, but we'll see in the long term if it bounces back as well.
No, that's a really good point. It's tough to know whether how it will play out. I mean, with consider one of the reasons this whole market took off was in the last recession. There were huge foreclosure swaths of foreclosures in the Sun Belt that allowed these single family units to come to market, and it's not too hard to imagine something like that happening again, unfortunately. Sorry, Amy, we curtailed your discussion of RAD.
Oh, yeah, that's okay. So RAD is kind of an arcane topic. So the primary benefits for housing authorities to shift to RAD is the regulations are a little simpler in the Section 8 world and in the public housing world. And then also public housing has been so far consistently underfunded in the US for a long time. It's particularly true with respect, I think, to capital funding. So they'll do a better job providing operating subsidies, but then over time the buildings require a lot of deferred maintenance. And then so if you're looking, oh, how do I rehab this building? Frequently the answer is, well, I need additional capital. How do I get additional capital? Well, you're going to get additional capital by reaching out to private lenders, reaching out to tax credit investors, reaching out to private investors, and I think the people are in that side of the world. They like the low-income housing tax credit program, very familiar with it. They really like project-based Section 8. They're very familiar with it, and those are long-term contracts. But I think it's helpful to be out of public housing to access those opportunities. Specifically related to New York, I don't know the New York market in detail, but I actually do know somebody very involved in NYCHA. So if you email personally, I might be able to connect you.
I want to add about the vouchers. So what we're seeing on my project specifically, it's not across the board in all affordable housing project. We don't use vouchers. I mean, some projects in the past I've done we've used, but now we don't use it because some counties run out of them. So what I find myself in the situations, we actually put into COSER, the operating subsidies, 15, 30 years term to supplement what the counties don't have. So I think vouchers are great, Section 8s are great. They always subsidize on the services and operation side, but sometimes with a lack of funding and resources from the county, we have to privately, work with the county in partnership with it and finance all the operating subsidies on a long-term basis. So that shifted a little bit too.
And I think there's a little bit of a public policy tension where part of the purpose of the voucher program was to provide tenants with even greater mobility. So it wouldn't be moving from one public housing project to another, but potentially to be able to move everywhere. It's hard to underwrite deals where the voucher is with a tenant. And so you get better underwriting and thus, better terms on your debt and better terms for your equity and thus lower capital costs if you've got project-based sources. So just things that the industry is working through.
Yeah. But more vouchers are great. We need them. Yeah.
And I did notice on the old conversation about the impacts on potential markets. Somebody, Todd Gaskin, noted that on the single-family home side, there's been a little hesitancy on the jumbo market, and that's something that I can confirm because I was thinking of refinancing, and I was just talking with my mortgage broker, and ours would be conventional, but his explanation was that there's a greater insurance on the single-family side for the conventional backstopping those mortgages, and so they're viewed as a little safer. So it's similar to the whole flight to quality discussion we were talking about with large multifamily issuances.
So I think David has to drop off. He's done an excellent job moderating. We can take more questions between Eamon and I if there's any additional Q&A we want to discuss, or people can raise their hands and share their mic if they want to, or we can just go through the chat box and read through the comments. Eamon, do you want to moderate that and see where we are? I think you're.
Sure, yeah. I think sharing a mic might actually be a good idea. Do I have the ability to unmute various people?
Yeah, you do. You're done.
So maybe what we should do is if folks could raise their hand, then I can unmute you, and we can, have a little conversations among various groups, or yeah, we'll see how that goes.
Yeah, we have received.
So, okay, Gabriel area, so I see that, so I'll go there. Okay, you're online, Gabriel?
Can you hear me?
Yes.
Yep.
Yes, I was looking at actually two different areas that are concerning. Is one, are we going to see a change in taste and preferences, if you will, on the residential component? What I'm thinking is people are going to leave this period of lockdown and actually say, hey, I don't want to stay in this building anymore, or this unit, or this type of amenities are not what I want anymore in my life. And also talking with some of my clients, a lot of them have actually expressed, ironically, vice versa. Some want to leave more urban areas, and other ones want to go to more urban areas. So are we going to see also a migration created by people saying, my taste and preferences in housing has changed, or I can now work from home, so I don't need to live in X city?
Yeah, we were just actually, that's a great question, Gabriel. And, in metropolitan cities and urban cities, I've seen discussions amongst firms that will allow for workers to have more mobility and flexibility to work from home, which means there will be a decreasing needs perhaps of office spaces or even co-working spaces that were so popular before. And also what that means as a result of these offices being more vacant or being less utilized, can those be converted into housing, maybe affordable housing, maybe housing in general. So there had been some discussion about the result of COVID-19 and the demand of offices and workers' preferences in terms of actual housing preferences and housing design preferences and amenities. One thing that I can think of in terms of like the co-living spaces I was mentioning, it was all based on amenities and shared spaces. And I can see that definitely be impacted in terms of whether that will be a preference because of the public health issue. On the affordable housing side, specifically, what I do, permanent supportive housing, the very low income and homeless individuals, because it's not really driven by consumer preference, it's more service driven in terms of the types of medical or mental health support or any types of service, financial literacy. I don't see that type of amenities being utilized is heavily impacted by COVID-19. But what I do see is because a lot of cities, especially in California, have adopted the REACH code, which requires the buildings to be all electric. The amenities itself, such as car versus electric vehicle, things like that, as a result of code changes, affect the actual amenity community spaces, but not so much based on consumer preference. Eamon?
Okay.
Yeah, I agree. I mean, I think so. I can speak to this a little directly and then also generally. I mean, directly, our agency was actually in the process of moving, and the new headquarters building was being designed, and we're definitely rethinking certain things. I think that the view is that long term there will be more remote work. So things like, does everybody need an office, or should we have hot desking? I think things like big open spaces are probably going to go away or not be as popular. But there's, hot desking where you come in and you have a private office and you plop in your laptop, and you might have to come into the office 1 to 2 days a week, and every day you go on the night before and you reserve a room, and you go in there and you plop in your laptop and go there for your meetings, and then you're home the rest of the time. When you do that, you need less space for your workers. So the idea that the entire office market will just be obliterated, I think is a little much, but I do think that we can see increasingly deals where people come in once a week, or in the morning and not the afternoon, and people switch on and off. That is going to, I think, have a boon for outlying areas of major cities. So I'm thinking, Erie, Pennsylvania is probably too far, but maybe the Catskills or something like that, where folks who have a setup like that, who can come in once a week, may prefer that type of environment. And I was doing some researching, listening to residential real estate brokers who were saying that they're getting questions about space for home office, space for home gym, things like that. And I was alluding to that a little bit when I said, I think single family is kind of like this favored class among policy folks. And so I think the question is, there's going to be preference for it. So how can it be done responsibly? Like, built around train lines, built with sidewalks, built in energy efficient ways. But I think that the trend you were talking about, I absolutely agree.
And I was reading one of the comments by Reed, and I actually I want to address that because I 100% agree. I wouldn't use the term "get Harvard" on this, because it is a regional and statewide and national level, and actually international level as well, with the affordable housing needs. So I want to just zoom out and say that the affordable housing demand had always been around and has been exacerbated because of COVID-19. It just intensifies the need, but the fundamental issue had always been there. Things that are like income inequality, affordability based on wages versus the cost of living, increase in rents and mortgage prices. I mean, these are basic macroeconomic levels that really the past 10 years had really pushed affordable housing need to the forefront because of how different regions' economic markets cycle. And as a result of COVID, I think that just will intensify. So it's definitely a macro and micro level we have to address. But on our part, it's a partnership. So we definitely need to work with public agencies, private sectors, to see what we can advocate and push forward, as well as doing our part in terms of the production and investment front.
So I think I saw some maybe like hand raises that went away. I don't know if there's anyone else who wants to physically, join the conversation orally and ask a question of the group, or whether you want to go use the chat box. Okay.
Any questions or comments or opinions about this topic? Do you guys all work in affordable housing, or have an interest, or have any observations recently? You want to share?
Yeah, I'd say particularly, I do know we have a couple of international folks. If they kept on the line, we had a very U.S.-based discussion, and I would be curious to hear how folks in other markets are dealing with this global issue. Yeah.
I would say, how do we see the maintenance quotes or the HOA being at risk if there is an increase in the ACs and the HVACs, but also in the cleaning duties, and what could be probably a decrease, not in affordable housing, but single-family homes, multifamily homes, or vertical. I mean, that could probably put a strain on a lot of the administrators of the residences.
Yeah, I think that's a great question because I've had some specific conversations with our project managers about HVAC, where there's a concern that the virus, you know, could flow through HVAC systems, and the likelihood of that happening depends on the quality of the system. So we've had a big push in recent years for energy efficiency, and then sometimes that was a big savings. You'd rehab a project and make a bunch of money off of a more efficient system. I think there's going to need to be a lot of investment in cleaning, and then also really high quality HVAC systems, and that I think absolutely is going to have a strain on HOA budgets. Those systems are public.
Yeah, because I think hospitals designed with negative pressure where the HVAC doesn't go into the room, but it takes air out of the room or something. I'm not the expert on hospital design. But if we put that in housing, in affordable housing, it's probably going to be really expensive as a system. So I haven't heard my architects talked about specifically HVAC, but I think that would be a good point to bring up to see if we need to be very conscious about dealing with COVID-related issue with our mechanical, electrical, specifically the system.
Yeah, I don't think anybody that I was speaking to was thinking anywhere close to hospital level. I think it was more better filtration, you know, but would that better filtration be enough to deal with a virus, which is a particularly small particle? You know, I think that would be a question for the industrial engineers. But over time, we may see some innovation in the space generally with respect to, I think some of this situation has caused everyone to step back and think, I know I did, about like generally how the flu travels. You know, I think Japan saw, they locked down a little early, a decrease in just even regular flu cases due to a lot of their efforts. And so when you're thinking of building design, I think just how to make sure places are safe and sanitary is going to be in people's mind in a way it wasn't going forward related to this particular virus or any other sort of health hazard.
Yeah, I think on the design front, I mean, California is by the bay, or in the Bay Area is by the bay, and we have ocean. So recently there's been a lot of issues about like sea level and wanted to address that challenge. But with housing and a design for houses that are by the ocean, it might be, and this is complete speculation, it might be a little bit better because of the direct access to like the bay versus a congested metropolitan downtown urban area. But I think in terms of the design for housing and how COVID-19 affects it, I haven't really, and maybe some architects can address it, I haven't really seen any discussion on how this would work, with the exception of how users function and how that translates into design changes. So it becomes more mobile. People don't want to be in an office space or be in a congested area. It may be more spacious. It may be more malleable and flexible in terms of the space usage. So that's another thing that I was thinking too in terms of addressing the HVAC stuff.
Yeah. Hey, basically, I think unless there's folks that have specific questions, you know, they want to raise a hand for the group, it might be good to hit on the other webinar that we're doing in a couple weeks, and then maybe, you know, ways that the group could connect for future events. Or I know people have been sharing emails or have questions to each other, ways that we could connect after this to sort of keep the conversation going.
Yes, so we have a few minutes left. Gabriel had raised your hands, and I can talk about our next webinar. So Gabriel, go ahead. You want to unmute?
Yes, you asked about internationally. I was speaking with my friends in Europe and in Italy, and design-wise, what I thought was really interesting and the challenge that they're having is they're so used to actually the existing courtyards or inner courtyards of great buildings or residential the building blocks in Madrid, for example, or in Milan. They still have the inner core of those buildings where they have those clotheslines to dry out their laundry. And what they were telling me was the whole issue is that everyone is so scared. They're not drying their clothes outside the inner parts of their buildings. So I think we're going to start seeing a lot of not only cleaning, but also in living in existing or maybe outdated buildings. Where do you see it could be some areas that might be very interesting?
Yeah, that's a really interesting observations. I think the U.S., is slightly functions differently from international, and the clothesline issue is actually an interesting thought. Eamon, I see a question maybe you can answer. It's the last question from Will.
Oh, yeah. So Will asked, will the sudden demands placed on housing courts to adjudicate landlord-tenants issues, a huge number, result in any change to these courts and state laws that created them? I'd say right now, a lot of landlord-tenant things are on hold. I mean, I think larger litigation is ongoing, but evictions are stalled, and so I think a lot of cases are just stalled. Period. Obviously, at some point there's going to be a huge rush. I'll say I deal more with transactions, but occasionally does involve courts, and we do face landlord-tenant litigation where I am. Courts in particular are very slow moving and adapting to technology. And so, for example, in my state, the recording real estate is something where you still have to physically assemble a lot of originals and have somebody come into the recorder's office. We still will get evidence that it's been recorded a couple of days later. We don't get the actual recording information of the book and page. It could be weeks. Other jurisdictions have switched a few years ago to online e-recording. Hopefully situations like this are going to cause some local jurisdictions to take these things more seriously, keeping up with the trends. Ditto, I think, in litigation. Federal courts, you do e-filing quite frequently. A lot of state courts don't. And, look, face-to-face communication can be extremely important. And particularly if you have an issue, I think people want to be in front of a judge. So parts of it are always going to be face-to-face. I think that courts could use technology to deal with cases in a more efficient manner, deal with transactions in a more efficient manner. As for changes in laws, I think it might be a little speculative. I think that where a lot of people in the U.S. are in a very difficult situation right now, where for some people the government is telling you can't work, but you still have to pay rent. And I think everybody understands that we have to adapt to that and offer as much support as we can. Very long term, even we're a public agency that provides housing, and I used to represent a lot of nonprofits that provide housing. Even for folks that expect to make no profit whatsoever, you need some rent to keep the building up. So the overall structure, I think, will probably be similar with additional technological efficiencies.
Great. So I like to wrap this up and close our discussion, unless we have anyone who really wants to ask further questions right now. If not, we will probably move toward a close. I really appreciate everyone's participation, and I think that COVID-19 is such a universal health crisis that affects not just the US or not just specific regions and cities or states in the United States, but it's been a pandemic across the world. So I think as a result of that, and folks' response in design, development, and construction and affordable and multifamily housing varies across different regions and across different countries. So I'd encourage everyone to continue this discussion and share with us what you're experiencing and your observation in your specific region, and how you find the challenges and opportunities to be as a result of this, whether it's in design, any stage of the development cycle or financing or design cycle. And feel free to reach out to us. And transitioning to the next webinar we have on capital market. So the goal of this webinar is to continue to share with everyone dialogue and discussion opportunities in the midst of our sheltering in place. For me, it's been 2 months, so I think there's going to be maybe a few more weeks, more month, we're not sure. But this is a really great time to chat with everyone who are part of the alumni or students or faculties at Harvard. Our next webinar is really going to dive across, well, not dive, but talk about different asset classes and capital market trends and the observation in really from the East Coast perspective, because the two presenter will be based in Florida and New York. So they're going to dive into, you know, capital, debt, equity market, and talk about what they see specifically in different asset class, as well as the development of, from their perspective, the different asset class that they're going to provide an overview. They may touch a little bit about the East Coast or the West Coast and the Midwest slightly, and we can certainly set up more webinars in the future to talk, you know, per region or per coast or other parts of the world. So with that being said, I encourage people to reach out to us and join the other webinars. These are all free. And I do see one more chat, so I'm not missing out on anyone. Great. Yes, so let's all keep in touch. And if there's nothing else, I like to close. And let's keep this dialogue and figure out collectively what we can do to really help the industry and solve the problems that's facing that we're all experiencing. And I think part of the positive things from COVID-19 that comes out of it is the communities are pulling together to see how they can address the crisis, both on the public sector, private sector, different regions, different parts of the world. So let's keep it going as a Harvard community to work together to move this forward. Anything else?
Thank you. Nope, thank you.
Yep. Great. Well, thank you very much for your time. Really appreciate it. And let's keep in touch and we'll talk again soon. Okay, bye. Thank you.